Welcome to Drill Down Earnings. We're looking at the results from Cisco for our 300th Drill Down Earnings episode. I'm Cory Johnson, Chief Market Strategist for Epistrophy Capital Research. We look at the 50 most important companies in all of technology. Cisco is certainly one of them. And Cisco really turning things around after a difficult few years. The troubles only showed up in the stock price recently, but the problems have been brewing for a long time. So we can see the numbers, we can see the problems, we can see the resolution of those problems and start doing that right now. This is their second quarter for fiscal year 2025, and this is the business story behind a stock on a movie. Yeah, the stock was moving after these results came out. Revenues were up 9%. And that's good, because revenues were down on a year-over-year basis in this time last year and the subsequent 4 quarters. So for an entire year, we saw a declining Cisco despite massive spending and not only just growing their business, but also acquiring businesses, not least of which Splunk. So we're going to talk about all those things here. So their product orders, which is so crucial to future orders in service and security, were up 29%. That's really good for them. Up 11% if you exclude Splunk, which is mostly a software product, still really good for this company. As I mentioned, $14 billion in revenues. Revenue growth is back for this company. That's a really good thing. Now, operating margins at 22% while that's up from where it's been for most of the last year, it's still down from where it was exactly a year ago slightly. So the operating margins are still eroding a little bit, but 22%, like I said, is better. They'll take that. This has always been and remains a networking story. Yes, they've got security at 20%, a Splunk a terrific addition to that, as well as collaboration and observability. But 67%, we're going to call that 2/3 because I can do math, simple math. And that's 2/3 of revenues from networking here. And while networking shrunk, the growth was less worse. I don't know, negative 3% year over year, but that's a big improvement from the negative 30% we were looking at. The big problem there was inventories. We'll get into that in a second here. One of the numbers they give us, however, is our remaining performance obligations, or RPOs. So these are deals that are signed, but the question is, how much of those sort of 3 and 4 year deals, 3-year deals mostly, is going to happen in the next 12 months? And if a company's got a 3-year deal, but they're pushing out a lot of the work into the second and third year of a 3-year deal, that's not a super positive sign for Cisco, because it means that their customers aren't rushing to gobble up the services and products that they can. And so there is a concern here, in particular with product, that they've been pushing out the spending on these multi-year deals. But that's gotten a little bit better, or at least hasn't gotten worse in the last quarter, and the results we saw most recently in this second quarter. So that's good news for Cisco as well. How did the stock react? The stock went straight up. In after hours trading up 7%, it's held those levels. And indeed, the stock in the last year up 25%, which is a little bit better than the S&P 500 for a company that's going through a big turnaround here. The big change in Cisco's business here is the increase in security. Of course, a lot of that is Splunk. So 117% year over year increase isn't 117% more sales. It's the addition of Splunk and the recognition of that acquisition. And now Cisco has really folded Splunk into its efforts. Gary Steele, who was running Splunk as a separate company, who at Cisco was the head of go-to-market division, well, he's gone to market with his resume. He's taken another job as a CEO at another company, which is yet to be announced here. I want to talk about a visit that I had with a competitor, Splunk competitor, Palo Alto Networks. I was visiting with Palo Alto Networks a few weeks ago, maybe a couple months ago, and I talked to Nir Zuck, and he's the founder, one of the co-founders of Palo Alto Networks. And what he was talking about their competitors in the sort of what they call the SOC, the security operations centers for all these giant companies. They've always got an ability to sort of monitor on all these really cool giant screens what's going on with security in any individual company. Splunk sells those security operations center software systems, as does Palo Alto Networks. And Nir Zuck at Palo Alto Networks said, I'm not going to name the competitor, but they were sold to another business where technologies go to die. Yeah, he was talking about Cisco. So you wonder what's going on with closing deals at Splunk. Is this where technology is dying within Cisco? Because we can see the results where it's growing. And how different might that be underneath the Cisco umbrella? Here is a Cisco CEO, Chuck Robbins, talking about what was going on there with Splunk.
These are still, long sales cycles, and we're continuing to make progress. We are having wins. I mean, they're clearly out there. We also have seen the benefit of the portfolio coming together with large customers doing our broad-based, what we call WPAs, and that are inclusive of Splunk now, the old Cisco WPAs that are inclusive of Splunk. And we talked about the Splunk team that had a deal that they were leading that actually expanded the Cisco footprint. So we are beginning to see that, and we'll continue to see it as we go forward. I think you'll see as we get into the next couple of quarters, you're going to see more and more cross-selling sales incentives that the teams are putting in place that I think will continue to accelerate that.
So cross-selling means selling all the Cisco stuff and throwing a Splunk into those kinds of deals. That's a real Cisco way to do things after an acquisition. No company, I would argue, in the history of Silicon Valley has ever been better about folding in acquisitions than Cisco. And so there's certainly high hopes for Splunk here. Now, one last concern I want to mention. I told you that we could see the problems at Cisco long before you could see it in the stock price. And the problems you could see was mounting inventory. Of course, inventory stacks up at customers long before. Customers order when things are hot and they don't think they're getting enough product. But they hold on to that product, and when they keep ordering, and when the inventory starts to stack up at a company, it's usually after it's stacked up at the end market at a customer. So when you saw the days of inventory, that is how many days it would take Cisco to go through the inventory they've got in their shelves, rising and rising and rising and rising for years, you knew problems were going to come, and certainly that happened in the last year with Cisco. But inventory is now getting a little bit better, down to 55 days. That's not great by Cisco standards, but that's an improvement, and it's been improving for the last few quarters. That's probably a good sign for Cisco going forward. All right, what's the number that tells you a whole lot, and what's the one number that the drill down earnings bite? What's our summary of Cisco results? Well, second fiscal year 2025, second fiscal quarter 2025 earnings from Cisco. Here's what we saw. We saw $14 billion in revenues. It's 11% on a year-over-year basis for product sales when you exclude Splunk, their acquisition, but 9% revenue growth. That's a real positive for this company. That might be the number that tells a whole lot. The other number that tells a whole lot is 300. This is our 300th episode of Drill Down Earnings. Our goal was 200 in 1 year. We're way above that with 300 in about 13 months. Really happy with the feedback we've gotten in Drill Down Earnings. Tell us what you think. Leave us some comments. Hope you like what you're doing here, what we are doing here for you with Drill Down Earnings.